Welcome, everyone, to the Directed IRA Podcast. This is Mat Sorensen. I'm joined with a special guest today, Ahmed Ahmed from WeFunder. He's head of funds there. I'm going to have him introduce himself today, but what we're talking about is investing in venture or startups. This is an asset class your IRA can invest in. You can invest in, of course, with non-IRA dollars. But we actually had some clients use their IRAs to invest on deals that are on WeFunder. And there's a couple of different things that they do there. Ahmed will get into it. But Ahmed, welcome to the show today. Appreciate you being on.
Thank you, Matt. Yeah, happy to be on.
Tell us about WeFunder and kind of your role there.
Cool. Yeah, happy to give a little bit of background. So WeFunder is Robinhood for startup investing. We are a YC company. We started in the winter 13 batch. And for most of our time and efforts are spent towards the Reg CF side of the business. So unaccredited investors can invest in startups through Regulation Crowdfunding, which was legalized during the Jobs Act in 2016.
And Reg CF is for someone that's like, hey, I'm not accredited, and you could still be accredited and do it, but like unaccredited, basically anyone could invest through Reg CF offerings. These are not publicly traded companies. These are small startups, right? How much is a typical investment in Reg CF though? Because those are usually smaller dollar investments because that's that crowdfunding concept. Get a lot of investors in at smaller amounts.
Yeah. So the median investment on WeFunder for Regulation Crowdfunding is $250. The average investment is around $1,000. And I'd say typically a company would raise around $250,000 total from Reg CF on average. We have multiple companies that raise $5 million from Reg CF, which is the legal limit. People add on to that through Reg D. And then, so particularly it's for smaller check sizes on Reg CF. And I think the most successful cases on Reg CF are companies that just have a lot of customers and they think it's cool that their customers can be shareholders. Mercury has done that. Substack has done that. Replit has done that. And they just had an overwhelmingly positive response. And it's more like a cult following when you introduce that. I think it's primarily the best form of marketing you can have.
Yeah. Have some people invest in you. They're like invested in your success, literally. Okay. Now there's another side though of what WeFunder does, which is more on the more of a fund, typical fund structure side. Tell me about that. If someone's maybe an accredited investor.
Yeah. So the other part of WeFunder, as you alluded to, is the Reg D side. So if you are accredited, or a step further, a qualified purchaser, we offer you exclusive deals that would only be offered through Silicon Valley, and easy for anyone to invest. It's the same checkout flow as Reg CF. So you just see a deal you like, you put in your bank account information or your directed IRA, and then you just invest straight through that. So my side of the business is particularly seed and Series A companies. We have Series Ds and beyond. So we offered like Anthropic, OpenAI, SpaceX, XAI, a dozen more companies like that. But we also offer something called the Orange Funds, which I particularly am really excited about, and I spend a lot of my time at WeFunder on. So the Orange Funds, the goal of it is to almost emulate and track the Y Combinator batches as an index. So for those who don't know, Y Combinator is regarded as the most elite accelerator in the world. Companies who go into Y Combinator have a much higher chance of succeeding than those who don't. I think the percentage chance of a Y Combinator becoming a unicorn, so $1 billion in valuation, is at 5%, which is 5x a normal company. And the power law dictates that if you just invest in Y Combinator companies, you will make a higher return than if you invest in other companies.
Yeah.
Going back,
and some of the companies from Y Combinator, that's like Stripe, I think, is from Y Combinator.
Stripe, Airbnb.
Well, what are some of the ones that are like recent? Yeah, the big ones everybody's used.
Yeah, I think the most recent ones that are, there are different. So recent markups, I guess, that are in the news. We just got a markup for 8 Sleep.
Oh,
Um,
okay. I love 8 Sleep. I use 8 Sleep.
yeah,
You can get your
shout,
promo code Matt. Go to 8sleep.com. No, I'm just joking. They're always advertising on podcasts, but I do
I was
love my
about to
8
look that up.
Sleep bed. Yeah, 8 Sleep, if you're listening, hook me up. I bought 3 of them, for crying out loud. Love the 8 Sleep bed. Okay, so what's their markup now?
I believe we're at 40x for 8 Sleep.
Okay,
We invested in their YC round at a 20 million valuation.
cool.
I believe they just raised at an 850 million valuation. So congrats, 8 Sleep.
Yeah,
Uh, yeah, but it was a nice little markup for us.
cool.
And then the most recent companies that have gone through the batches that are doing quite well. Corgi is a AI insurance company. We invested in them in, I believe, summer of 24 or 23. They just raised their Series A. Artisan, if you're an SF native, you would have seen their billboards everywhere. They're the AI like sales company, or
Hmm.
avatar company. They just raised their Series A, and we're seeing a lot more companies coming from YC raise their
Yeah.
Series A much faster than normal.
So that's the orange funds, though. So it's like, so if I invest in, like, you call them the orange funds,
Yeah,
then that has allocation to some of these companies coming out of Y Combinator.
yeah. So the aim
Okay.
for the orange funds is YC will typically get 200 companies in every YC batch.
Yeah.
It ranges between like 170 and 200. We try to pick the top 25 to 30 companies in each
Yeah.
batch, and we just go out and get allocations across the board.
Okay.
We usually do that through, like, I will split the work with 2 other YC alumni or 3 other YC alumni with domain expertise in that thing. So
Yeah.
we're running the S25 batch, which a couple of your users have invested in,
Hmm.
and one person is focused on dev tools, for example. They've ran successful companies in dev tools, so they know I trust them more than anyone to decide
Yeah.
what's a good investment on that. The other person is focused solely on AI research, so large language models, contexts, MCPs, those things that, like, I never understood until like 3 months ago. Their entire life's work is based on that, so I
Yeah.
trust them to decide. And then I have a biotech research, so I was a cancer researcher for 5 years of my life, and I've been taking calls with anything that is remotely close to automating biological research. And there are a couple of good ones this batch, which I was really excited about. So we try to determine
Hmm.
which ones are most poised to win, and we just
Yeah.
spread the board.
So these ones, let's talk about then kind of like that seed series A type stuff. I mean, these are really early stage investing. Is that what these are going to be in, like, let's see, these orange funds, for example? These are like, they may have a product already, but they probably don't have sales. Do they have sales and revenue yet? Like, where are we talking here on, like, and help people understand maybe kind of what seed and series A is, how early that is.
Yeah. So I think primarily, if you're not investing in a YC batch, you could think of seed as they have an MVP, so minimally viable product. They like have hacked something together that is useful for companies, but is not really like at the standard for an enterprise customer.
Hmm.
And that's primarily where a lot of the YC companies start the batch at. So if you apply to YC, you are required. You're basically like, the only chance you have to get in is if you're not ex OpenAI, ex Stanford. You have to have an
Yeah.
MVP to get in,
Yeah.
and that's where you start. You then have 3 months of the most intensive boot camp you can have for a startup. You
Hmm.
have Sam Altman coming in to give you talks. You have the Airbnb founder Brian Chesky coming in to give you talks. Paul Graham, who's regarded as the most elite startup investor in the
Yeah.
valley. He like advises companies, and in 3 months, you are basically expected to showcase your product in something called Demo Day, which is used to be for investors to go in and decide which companies to invest in.
Hmm.
Currently, companies oversubscribe their rounds before them. Uh, but at that point, mostly they're starting to have revenue. They're starting to close
Yeah.
these enterprise contracts, and some of them are actually going really heavy and closing really big names. We invested in a company called I'm not going to say their name because I don't know if this is public information yet. But we invested in a company that closed Lovable as a customer. Lovable is the fastest growing startup in history. They were first to get to $100 million in annually recurring revenue. So they're closing really big names, and this is still pre-seed.
Yeah.
So the orange funds, or the YC funds in particular, I think accelerate faster than anything else.
Yeah. So Y Combinator, just for people to understand, I mean, this is like, if you're not familiar with it, is like, it is a pretty elite place for if you're a startup, particularly in the tech space, and you have a very compelling big idea where you go get help and mentorship. And it's like, it's very hard to get in. If you get in, it's like kind of like this badge of honor that, we got into YC. And so venture and startup investors are like, that's like that's a diligence box checked for us, is like, if the people at YC thought that this was good enough to get in, then there must be some validation to it. Now, most startups fail, right? And that's the thing we got to understand in this category is the most likely outcome is that if you just invest in one company, is it's going to fail, particularly at these early stages. And we can talk about Series D here later and some of this more late stage investing. But and I just wanted your opinion on this, Ahmed. I mean, we had at our event, we have an alt asset summit that we do every year. By the way, it's October 16th and 17th, everyone, altassetsummit.com in Scottsdale, Arizona this year. But we did one in California, in Southern California, 2 years ago. And we had a speaker. She was the president of Tech Coast Angels. They do a lot of angel investing. I remember one of her comments was, if you invest in 10 startups, and this is as an angel investor, but this is going to be early stages, the most likely outcome of nine of them will fail, and maybe one makes it. But your hope is that one that makes it goes 100x and it delivers a significant return. I mean, for someone that's new to investing in venture and startup, how should someone think about that? And like, what's their expectation going in? And I know you have the fund model too, we can talk about here, but just as they're thinking about like individual company investing, and how should they look at this asset class?
I think there's a different way to look at startup investing than Silicon Valley does currently.
Yeah.
There's a certain naivety that comes with being an angel investor in the Valley. But I think the advice I usually give to people is like diversifying your financials and your investments. If you're going through your IRA and you're picking X amount goes to government bonds, X amount goes to real estate, X amount goes to ETFs, I personally put in 5% of my investment over the year to go to startups. And I probably could increase it because I have insider knowledge and that is my job. So
invest in what you know.
Exactly.
Yeah, like invest in where you know. I totally believe in that.
But I truly believe the amount of capital that goes into these private companies and the timeline for these companies to go public being so much longer than it ever has been before. We recently saw Figma's IPO. Cerebrus's IPO has gone through, but it's been delayed so many times. Companies like Databricks is planning to IPO. Anthropic just raised their next Series B, I believe. Series C. They're going to take some time to IPO. SpaceX is, God knows when they IPO. Companies are staying private longer. There is more money than has ever been before in these private markets. I do think people are missing out on money if they just rely on public markets.
Yeah. So if I'm going to invest in that asset class though, should I be thinking of a fund model then? Because if I need to diversify, I'm diversifying within all asset classes, I guess, by putting some into real estate, some into stocks, some into bonds, whatever the typical advisor advice would be. But if you're like, all right, well, I'm going to put 5% into venture, let's say, like, how do I do that? I mean, this is what WeFunder is like. You've kind of like have solutions for this and making it easy, and it's like smaller amounts, but also what if 5% for me is, 250,000, like, but I don't want to just buy one company at that amount, so how do I start figuring that out, how to invest in that if I'm interested in that asset category and I want to start doing it? What are my options to do that?
Yeah. So we have different asset classes or different ways you can invest on WeFunder in Reg D primarily. The orange funds is a good way to diversify, but it's still very narrow in terms
How
of
many
asset
companies are in an
classes.
orange fund or in those funds?
Usually it's around 26 to 30.
Okay. All right.
And YC only accepts tech companies, and if you think that's like a lack of diversification, there are other ways to go about it. But the orange funds usually return around 30% IRR. So I do think they're like a good class to diversify. The amount of
Mm-hmm.
the different companies we get are very random when you look at it in 3 months' time.
Okay.
Yesterday I had a call with a biotech company. The day before I had a call with a drone company that maps how much bale and hay a farmer has collected.
Okay.
The I think that's the true nature of diversification.
Okay. Yeah.
But in general, we have different funds. I launched a biotech fund a few months back called Helix, and that was primarily just ways to accelerate research and anything that goes through FDA testing, just accelerating that process. We are planning to launch an AI fund, a national defense fund, a robotics fund, and those are like different asset classes that people could be interested in. From historical research and context, people that invest in these specific funds tend to have specific domain knowledge in that technology.
Mm-hmm.
So we get a lot of requests for the biotech fund, and that just happens to be the people that are trying to request for it are doctors, and
Yeah.
they believe that they know what they're looking at, and they want something that's closer to home. So they're specifically asked for that. Other people don't want to do the research on AI, and it moves so quickly, and new companies spawn every other day, and competitors become obsolete. People win, um, and they don't want to like have to keep up with that, but they know that is going to be the future. So they're just like someone like me to just
Mm-hmm.
grind through it and understand the market. So they want
Yeah.
that asset class. Um, so I'd say if you're trying to diversify and you're a WeFunder investor trying to invest in Reg D, I would look at one of the funds and invest your money in that. However, I would keep an eye out on the individual deals that we get. We usually average
Mm-hmm.
around 2 a month. Those are the OpenAIs, the Anthropics, the SpaceX. And if you like said company, and I think those companies are big enough where there's enough data for you to make a decision on, I would save some money for those.
Okay. So like right now on your guys' platform, could I invest into space? I could invest into SpaceX or
We
OpenAI,
run
Anthropic.
we run rolling funds
Okay.
where they're only open for around 2 weeks at a time for that specific company.
Mm-hmm.
We closed Anthropic around 2 weeks ago, and that was open
Okay.
for 3 weeks. We before then we did another XAI round. So what we do is when a round becomes open, we get an allocation. We'll send it out to the people that have invested in the funds before.
Mm-hmm.
First, they get early access, and then after that, we open it up a little bit more before we get oversubscribed again. And people usually have a timer of 2 weeks to fund their investment, and then that's
Okay.
all the investments we're taking in.
Okay. Are those individual investments are those Reg CF typically, since they're not in a fund model, or are those any of the Reg D, or those all Reg CF?
They're Reg D.
They're Reg
Those,
D. Okay.
yeah,
Those are Reg D. Okay.
those are Reg
All
D.
right.
If you want to invest
Okay.
in any company currently on Reg CF,
Yeah.
you can go to WeFunder, and then on our explore page you don't have to be accredited on that. There are, I
Yeah.
think, over 180 companies currently open for investment.
Okay. So, all right. So let's say I've determined the amount of money I want to invest. And maybe I even want to use my IRA. Of course, you can do that with your account here at Directed IRA. You can invest in venture and startups. You can use WeFunder. We've had many accounts invest in that. I think we'll see more and more do that as this asset class is becoming more accessible, I think, to individual investors. And I think that's one of the missions that WeFunder has done, is try to bring this asset class to individual investors instead of just the wealthy Silicon Valley or the venture firms. I know there's a lot of people who like to kind of follow other prominent firms and investments. And I've seen this on WeFunder too, to see who else is invested in this. You guys typically will indicate if there's been a well-known venture firm or someone else that's invested in the company. And I think that's a nice thing to know, right? You kind of like this follow the leader maybe type model. But what else are things people should look at? You maybe talk about that or some other things when they're analyzing these different opportunities to see what's a positive or a negative thing I should look at. And I get there's different asset classes and things. Invest in what you know in those categories you like. But what should other people maybe be paying attention to as they're looking, that you guys might have show in the diligence docs or kind of information for them to digest?
I think there's two different distinctions there. So Reg CF companies are required to file a Form C. You get a lot more information that's legally mandated to be there. So if you're raising up to 5 million, you have to file an audit. If you're raising up to 1.25 million, you have to file a financial review. So you get access to their financials, which is big for Reg CF companies. For startups, it doesn't really matter that much because realistically, you're
It's
not
like a bunch of
investing.
zeros.
Yeah, it's a bunch of zeros. You're not really investing in there like, oh, wow, they made 30 grand of revenue this year.
Right.
What you're investing in is particularly the founder. And I think that's what a lot of people get wrong. They put a lot of emphasis on the company's current traction and the current product state, and they don't look at the founder.
Yeah.
A analogy I give is Parker Conrad, who was the Zenefits founder, then turned to Rippling. He was regarded as the best founder some people have met in terms of just sheer ambition and drive. And if you looked at Zenefits at the time that they started, so I believe they were Winter 13, you would have not invested in them if you were basing it off traction and current product state. But if you had no idea what he was building and just had coffee with him for 5 minutes, you would have maybe sunk your life savings in him. And it's harder to do when you're looking at stuff on WeFunder because you can't call the founder. But there's enough that you can get in like watching the founder video. Looking if they're on the accredited, and if it's a venture funds investment, look up YouTube videos on the founder. We'll show videos on the profile when we're looking at pages and their current traction, obviously, and like the product state. But what I mostly look for is, does this person have an inkling of what it takes to be the next Mark Zuckerberg? And that's something that Sam Altman has like repeatedly said he looks for at startups. And I think that's the biggest differentiator.
Yeah. I mean, you're investing in the person as much as you are in their idea, right? Their idea or their product or concept or company. I mean, the person that's going to execute that, you're investing in that as much as anything else. I totally agree with that. So, all right. So I can maybe see some other, I know you guys will provide some detail if there's been some like marquee venture investors that have invested. Look to who the founder is, or maybe there's some co-founders involved too. Try to get a feel for them. Obviously understand the vision of what they're trying to create. Is there a big, do you see that breaking through? And, you have to use your own judgment on this. This is, of course, the fun part of the investing, is able to make those types of decisions and analyze that for yourself. So, and of course, we're not giving investment advice here at all. That's not our role. We're not giving investment advice. I don't think you're doing that at WeFunder. For us, we're just trying to provide access with your IRA to invest in what you know and what you believe in, and to take control of your retirement account funds. And I think places like WeFunder are a great place to go because they're providing this opportunity for everybody. It's not just, you have to get the right connection, or you have to even be uber wealthy. You can even, through these Reg CF offerings, it's open to everyone to have some type of allocation, even if it's $250, as we talked about, into ventures, or startups. So any other words of advice for people as they get on WeFunder, or they're looking at venture startups, that you'd want to point people to? I don't know if there's any getting started stuff. Sounds like registering to get information when you are like, let's say you're like, oh, I want to get the next XAI allocation or the next, what is because there's notices, I guess, you're sending out on that to people on the platform.
Yeah. If you're interested in just joining WeFunder as a investor to invest in Reg CF or Reg D, that's really easy. Just go to WeFunder.com, and then you can sign up. To get access to the accredited deals, you have to set yourself as an accredited investor as you sign up through the flow, which is simple to do. And then the way we notify people is just through email. So please make sure you're
read the emails.
You read your emails when they come from me or WeFunder. But yeah,
awesome.
It is easy to invest, and that's the entire. We're not giving investment advice. The only job I have and I'm striving for is to allow anyone to have the same level of access as a Silicon Valley insider does.
Awesome. Well, I love that. Thanks, Ahmed, for coming on and sharing this. Where should we send people to? Just to the main page? Is there any place we should send them? Any getting started place, or just get to the main homepage?
Yeah, WeFunder.com/home. Good place to start. If you guys want any information regarding connecting your Directed IRA account to WeFunder, feel free to shoot us an email. We're happy to help.
Cool. All right. Okay. We'll put that information in the show notes and provide that links. Ahmed, thanks for coming on. Thanks for everyone tuning in. We'll be back next week with another incredible Directed IRA podcast. Until then, stay calm, self-direct on.
And thank you everyone for listening. A quick disclaimer and reminder. This presentation does not constitute an attorney or CPA client relationship, and it is always in your best interest to consult competent legal and tax professionals when conducting your own personal transactions.
We also want to make sure you know this is not investment advice or financial advice. We're just trying to give you education, ideas, and strategies you can take to your professionals or conduct your own research on. We'll see you next time.